Hey everyone, and welcome back to another stock market Q&A video for the month of October. And as always, thanks everyone for leaving questions below the post of last month's video, as well as on the community board. And as always, if you want to ask a question, the best place that you can do it and the best way that you can make sure that your question gets answered in the next month's video is to hit subscribe and make sure you keep an eye out in your subscription box where I make the post on the community board, essentially asking for questions. I do it every single month about a week before I make the video. So make sure you hit subscribe, make sure you're subscribed, hit the notification bell if you want to be notified when the post is made, and that way you can get your question in quickly. In this video, we're going to go through one by one and answer every single question. So let's go through and see how many we can get through. The first question we've got here is from John. And John asks, how do you forecast a dividend of a company since it's a voluntary event? It becomes even more difficult if it's a volatile business. Do companies have policies that mandate a minimum dividend yield? Okay, so to answer your second question, no, there is no companies, for the most part of what I'm aware of, companies never mandate a dividend yield. And I think that's just to protect themselves legally. I mean, they always want to have the option to not have to pay out the capital. But you're right. How do we forecast it? Because essentially management gets all of the cash that's left over after the normal operations of the business, after maintaining their assets. We call this cash flow for owners. And then management decides if they're going to pay some out as a dividend. Are they going to buy back some stock? Are they going to invest in some new buildings, some new land, expanding the manufacturing facilities or something like that? They have all of the power to decide what they do with that cash. So ultimately my answer to this question is that I don't try and forecast the dividends that a company is going to pay. There's certain types of people who will be able to help you invest for maximum cash flow, for the maximum dividends that you can produce out of your portfolio. But that's not what I teach on my channel, and that's not the approach that I've been taking. I don't really care about maximum cash flow for us in terms of dividends. I don't really care about maximizing dividends. I care about maximizing long-term growth. So I still care about cash flows within the business, but I would much prefer that a management team keeps the cash flows within the business, invests it within the business, and returns a high return on invested capital, and therefore grows the value of the company over the long term. So some of the companies that I look at that are going to be great for long-term growth also pay a proportion of their earnings out as a dividend, but I don't try and estimate what dividends I'm going to receive. I try and calculate, using cash flow for owners, the total amount of cash that will be returned to shareholders, either through a dividend or through stock price appreciation. I don't try and separate them and work out how much the stock price is going to go up and then how much the dividend is going to be paid over the next 10 years. I just lump them together and I just say, I want to make a return of 15%. I don't care if 11% per year comes from the stock price and 4% comes from the dividend, or if 0% comes from the dividend and 15% comes from the stock price. I'm a long-term investor and I'm investing for long-term growth. So I don't really try and forecast dividends that a company is going to pay. So if you're interested in learning more about that, I think that there's probably some other people out there, especially on YouTube, definitely there is, that sort of teach people exactly how to maximize dividends and how to forecast dividends and that sort of thing. It's just not what I personally do. The second question here is, how do you account for companies that have multiple classes of shares? Does this alter valuation? That's a really good question, actually. And it's something that maybe a lot of people wouldn't understand straight away. And there's no one clear-cut answer for every company. It depends on the rules that the company puts on the different types of shares. But the most common types of shares that you will see is some companies have, say, a two-class tier. So they'll have Class A shares and then Class B shares. I think what Alphabet Google does is they have three classes of shares. So they have their Class A shares, which are one share plus one voting share, essentially one vote. And they have Class C shares, which are one share but no voting. And then they have the Class B shares, which are just for inner management, which are just voting shares. But one of the major rules that you'll probably see across many companies that have multiple classed shares is that the internal manager shares will have some maybe 10 votes per share. So they'll be weighted more on the voting side, and that's usually to give the founder a little bit more voting power. But usually those shares that are not publicly traded will be convertible. So it's an option that the manager or the founder converts those shares into traditional shares. But the best way to figure out if this is going to impact the total amount of shares and valuation and that sort of thing, because I guess what I talk about a lot on the channel is valuing a company as a whole company and then dividing it by the number of shares. So the best way that you can do that is just look at the latest income statement from the company, and at the bottom of that income statement there will be a number that says diluted shares outstanding, and that is the number of common shares that you want to divide the market capitalization by when you're calculating the per share value of a company. The next question we've got here is from Luke, and Luke asks, is a company ever too small? Do you have a specific market cap that a company must exceed in order for you to invest? The immediate answer to that question of does the size matter is no. I don't care what the market cap of the business is in itself. So I don't care about the price in isolation. I care about the price compared to the cash flows that we can get out of the business. So if we can do a thorough analysis of a company and confidently estimate the cash flows that a business will produce, and those cash flows are high relative to the market cap, I don't really care what the market cap is, whether it's 50 million, 100 million, 100 billion. But with that said, the higher market cap that you go, generally if you're looking at companies over 500 million, over $1 billion and up, those are the kinds of companies that will more likely fit the process that we go through. Because remember, first we need to understand the business, but the business also needs to have 10 years of data. So they need to be on the stock market for at least 10 years, and preferably a lot more than 10 years so that we can check them out and see how they've survived through recessions and that sort of thing. So generally they need to have a long track record of consistent earnings. And generally speaking, not all the time, but generally speaking, the very small micro cap, small cap stocks will be businesses that are either not profitable, or their earnings are very volatile, or they just haven't been on the stock market for very long. So for that reason, I generally find myself looking at businesses that are at least 500 million in size. My favorite range, although I don't preference this is just the range that I find myself looking into the most, is between 500 million and about 10 billion. But I always look at businesses above sometimes. And as I said, the actual market capitalization itself really doesn't matter to me. I just compare that to the cash flows that we can produce. And those cash flows need to be highly consistent, and we need to be confident in them. And in order for us to be confident in those cash flows, it needs to pass all of the other stages of analysis. The next question we've got here is from Joshua, and Joshua asks, how do we go about investing nowadays when the market is super overvalued in most instances? Do we simply dollar cost average into market tracking ETFs and or build a significant cash position? Is there other alternatives we can consider? So it depends on what your strategy is to start off with. If you're just passively investing, then the best strategy for investing in not earnings per share, investing into ETFs, exchange traded funds, index funds, is to dollar cost average. Because when you're buying into an index fund, you're not going to be able to value that index fund, because to value the index fund, you would need to know the cash flows of all of the businesses within that index, which is usually 100, 200, 300, 400, 500 businesses. So that's off the table in my eyes. If you're using an index fund, then I would just consistently invest, dollar cost average into it, no matter what the price is in the market. And that way you will capture over time, over a 10, 20 year period, you will capture the average market return. But if you're picking individual businesses, then your strategy doesn't change just because the market is more expensive. You're still looking in industries that you understand. You're looking for individual businesses and comparing their cash flows to the price of the business. And if those cash flows if the price of the business has risen too fast and the return that you can get from the business based on the price and comparing it to the cash flows, if the return is really low, then you don't invest. When your income comes into your investment portfolio, You just let it build up more and more into cash. And then once there is an opportunity available, then you want to invest into that. It's really, there's no rule where like if the market broadly looks overvalued that you'd pull all your money out. That's timing the market. I think that's a terrible idea. But just looking at individual businesses and seeing what return you can conservatively get out of them. And don't get me wrong, just because everything is, broadly speaking, overvalued, looking at historical standards, that doesn't mean that there's no opportunities. I'm still finding a small number of opportunities, not many, I will say, but there are a small number of opportunities. And if you just focus on trying to find one really great business at a time, then even if the market is overvalued for the next year, you will at least be able to develop an understanding of some businesses that are great. And if their prices come down in the future, then you can go and invest into them. The next question we've got here is, love your videos and approach towards investing. Thank you very much. Coming to my question. I understand that as a value investor, you don't worry much about the stock price dropping in your portfolio, and you believe in staying invested forever or for a very long time. But still, as a value investor, how much price drop can you take? Basically, is there any stop loss strategy which a value investor should follow? That's a really good question. And essentially, when the stock price of a company you own or a company you're looking at falls, you really need to dig deep and find out what is the reason for that price drop. If the price drop is for some reason that makes the company look really uncertain over the long term, then you don't want to be involved in those companies. Really, my rule is that as long as the company still fits the criteria, then I want the price to go as low as possible, because as long as the company fits our criteria, it's one that we understand, it's one that has a long-term competitive advantage or multiple competitive advantages, and we are feeling confident in the management team, then we want the price to go down as far as possible, because it means that those cash flows are going to be consistent and we can be confident in our conservative estimations of what we're going to get out of them. And if the price just goes lower, it just offers us a better opportunity to buy in more. But where you will get into trouble is if you don't understand the business, if it doesn't have a distinct competitive advantage, and you haven't assessed management. Because what will happen is the stock price will fall 50%, something will come out in the news about some technical change in the industry or the business, and you won't know what is going on because you don't understand the business, and you'll panic. And what you'll do is you'll probably end up selling for a loss. So in order to have the stomach to hold on to businesses, you need to know that business is great in the first place, and you need to be confident in your estimations. I mean, this is just part of patience and discipline that you will learn through investing over time. I mean, Warren Buffett says that over your lifetime, have a punch card where you only invest into 10 to 20 different businesses. And that's the approach that I've taken. I've made very few investments, but when I've made investments, I've felt very confident in them, and I've been able to put significant amounts of money into them. So I guess how much price drop can you take? I mean, if it's a great business and the long-term cash flows are, if your conservative estimates of the long-term cash flows are safe, then it really doesn't matter how low the price goes, because it means that over the long term, those cash flows will be returned to shareholders either through the price going back up or through dividends. But if you have some crappy business that you don't understand, then you're not going to have any confidence in order to continue investing while the stock is down. The next question we've got here is, could you elaborate on the importance of free cash flow and how in many cases it can be a measure of owner's earnings? Yeah, so free cash flow is essentially operating cash flow minus capital expenditure, total capital expenditure. And that is very similar to the cash flow for owners figure that I use. It's sometimes called owner's earnings. I think that's what Warren Buffett calls it. And that figure is operating cash flow minus maintenance capital expenditure. And the key difference there is that the number that I use doesn't subtract growth capital expenditure. And the reason why I do that is because then we have cash flow for owners, which is a figure of how much cash is left over after the normal operations of the business, and then also after all of the assets, machinery, property, buildings have been restored to their original position. how much cash is left over to invest into the business. And essentially, if you just want to be more conservative, if you want to be on the safe side, then you can just use free cash flow, because free cash flow basically assumes that all of capital expenditure is maintenance. And this is really, this is the best measure of how much cash is going to be returned to shareholders, because this is the cash that's either distributed as a dividend, used to buy back stock, which if the stock price goes up over the long term will benefit shareholders. It's used to reinvest within the company to grow the cash flows of the business. It's used to pay down debt, which increases equity within the company. And it also is used to keep cash, if they might just keep it as cash on the balance sheet, which represents potential to invest in the future or potential to pay out a dividend. So all of the uses of free cash flow benefit shareholders, either through the stock price going up because the value of the company goes up, or by directly getting it distributed to them through a dividend. That being said, we can't just use free cash flow in isolation. We need to use it. It has its place among all of the numbers, among revenue, earnings on the income statement, and equity as well, and a few of the other numbers. But it has its place. And I guess one example of the reason why we can't look at free cash flow in isolation is because businesses can postpone cash payments. So on the income statement, if a business incurs a fine, for example, then even if they haven't paid the fine yet, it will appear on the income statement. So it will be subtracted from their revenue, which is pretty fair enough. Whereas on the cash flow statement, it might not appear for 3, 4, 5, 6 years until they've paid that fine. If they postpone it, maybe a fine's a bad example because they'd have to pay it in a certain period of time, but they might have some other lump sum payment that they're able to put off into the future. And for that reason, that wouldn't be represented in their cash flows, but would rather be represented on the income statement. So it has its place, but it's certainly my favorite measure when looking at averages and looking over a 10-year period. It's certainly my favorite measure of how much cash is going to be ultimately put in my pocket as an investor, either through the value of the company growing, stock price going up over the long term, and through a dividend. And the final question that we had time for here today is it worth waiting for ETF prices to go down to within margin of safety price rather than passively investing dollar cost averaging with regular intervals? Yeah, so I kind of explained this a little bit earlier, but really when it comes to ETFs, my philosophy is that if you were going to try and value an ETF, and objectively value it, then you would need to be comparing the price of the ETF, which is ultimately the market cap of all of the businesses within it, to the cash flows that each of the businesses are going to produce in the future. And I think that's something that's impossible. I think that we're more likely going to have success in finding 5 to 10 businesses that we can estimate the cash flows of. And I think anything beyond that is not possible to do because we have limited resources as humans. So my philosophy when it comes to ETFs is to use it to capture the market average. And in order to best capture the market average, you have to dollar cost average. You invest consistent amounts at consistent intervals, and therefore you capture all of the price movements of that ETF over time, and you kind of get right in the middle of all of those up and downs. I don't try and value them at all. I have about 10% of my portfolio in an index fund that tracks the Australian market, and I just passively invest into that. I don't value it. I'm just trying to capture the market average and keep that as a foundation for the bottom of my portfolio as a bit of a hedge against my individual picks. So that's all we had time for today in terms of questions. Thanks everyone for submitting a question, and I apologize if I didn't make it to your question, but feel free to ask it again by leaving a comment down below this or by being subscribed and watching out for the post on the community board that I'm going to make probably in about 4 weeks time. One other thing that I just wanted to mention, there's a company called SHARESIGHT that has a great product for tracking your portfolio and keeping track of your taxes and all of the different things related to tracking the performance of your portfolio in terms of the capital gains, dividends, reinvestment plans, and currency gains and all of that sort of thing. It's a fantastic platform that I've been using for the past 3 years, so I thought I would bring it to your attention again. I have a link below to my full review of the platform if you want to check out all of the features in the on all of the features really that are available on it before you go and sign up if you're interested. But there is a free trial that you can use. Actually, there's a free plan that you can use, so you never have to pay a cent. But if you do go ahead and sign up to that and you want to check it out, then I'll leave a link to my special affiliate link down there. So if you do use that, again, as I said, there's a free plan, so you can use that link and it's going to be completely free. But if you do then go on to sign up to one of the paid plans, then you will be supporting the channel if you do use that link when you sign up to the free plan. But other than that, thanks everyone for watching, and if you're new around here, of course, hit subscribe, join us, why not? And other than that, I'll see you guys in the next video. See you later, guys.